Call to order the meeting of the Longview Firemen's Relief and Retirement Fund. If I could ask someone to serve as the secretary in Pam's absence and just take some quick notes for her, that would be wonderful. I believe all board members are present except one. Logan Ledkins is at a mandatory EMS training event this morning and is unable to attend. We have two guests in the room, Charles Smith and Will Harrell with Robert Harrell, Inc. I see no citizens for citizens comments, so with no other business, I will turn the floor over to Will for the presentation of the fourth quarter pension performance.
All right. Well, good morning, everyone. It's great to be in Longview. We'll jump right into the market commentary, and I'll be reading along in case, of course, y'all have this on your screen as well. So this is going to be kind of a year in review as of Q4 of 2023. After gaining nearly 17% for the first half of the year, the S&P ended the year up 26.3%, placing it firmly into bull market territory, as defined by 20% off a recent low. Since 1928, the index's average annual performance following a 20% yearly gain was 6.7%, with positive returns 68% of the time. As of the end of the year, the total return of the S&P was 26% for the trailing year, 10% per year for the trailing 3 years, and 15.7% per year for the last 5 years. Of course, that would include COVID and 2022 when the index was off 18.55%. Within the S&P 500, the 50 worst performing stocks in 22 averaged a gain of 50% in 23, outperforming the index by 24%. Conversely, the 50 best performing stocks of 22 averaged a gain of just 6.2% in 23 and underperformed the index by 20%. After finishing 22 down 13%, which was the worst year for bonds on record due to the Fed funds rate going from about a quarter of a point to 450 basis points, or rather 475, it rose 450 basis points. Bloomberg Barclays Ag was up 5.5%. And also for this year to date, just this short period, 6 weeks, S&P's up about 5%, had a rocky day the other day when we got some inflation numbers that were hotter than we thought, and we've had some jobs reports that were hotter than we thought coming in. And so the prospects of a Fed rate cut are waning, which is probably a good thing. Normalization for a little while longer won't kill anybody. And the December inflation, also I'd just say that bonds are down about 1% for this year to date. And the reason for that is that the bond market, we're not near that rollover point where interest rates, where anyone has any real confidence that interest rates are going to come down. In fact, that confidence, as I mentioned, is waning. Therefore, you see the bond market continuing to struggle. Yield on the 10-year Treasury note began the year at 4.5% and ended the year at 3.8%. That's for 2023. We have already jumped back up at the moment. We are running at about 4.2 to 4.3%, which again is indicative of the bond market not having much demand in it and watching the yields rise as bond values go down. And as I mentioned, I think in every meeting for the last year or so, when the bond market, when the bond investors believe that interest rates are truly going to be lowered, the demand for bonds is going to go through the roof, and you're going to watch the bond market have a great run. And the reason for that will be that if you've got a current bond paying 5%, and you believe that in a year's time you won't be able to find a bond paying more than 4%, the demand and the value of that 5% bond will just naturally go up and the bond market will rally. It's been a long time coming, actually. That negative 13% in 22 actually knocked the 5-year trailing bond index down to 0, which is how much damage for a bond for that particular data stream, that return stream. Negative 13% is just devastating. Fed's changed their tone in the last 12 months from higher for longer to preparing for investors for 3 potential rate cuts. I wouldn't blow up any balloons just yet. That most likely will not happen, but again, it's all dependent on the data. Real GDP grew by nearly 5% in the fourth quarter of 23, driven really by strong consumer spending and government spending. The infrastructure bill is really, that money just really hit the streets, so to speak, in that last quarter. The long-term average for GDP is 3.19%. And then the unemployment rate remained at 3.7%, about 6.3 million unemployed members of the workforce. Clients fully invested, diversified, and rebalanced diligently. This portfolio was rebalanced on December 20th or thereabouts to a zero tolerance. So every single manager, every slice of the pie has a designated target weight exposure. And so twice a year in the middle of June and the middle of December, we rebalance everything back to those target weights. So it's a risk management exercise, but it also forces us to recycle gains and simply sell high and buy low. So whatever assets have outpaced the others get sold off, and that money goes back into those that have been outpaced. S&P was up 11.7% for the fourth quarter, up 26% for the trailing year. Bond index was up 6.8% for the fourth quarter and up 5.5% for 23. International stocks were up 10% for the quarter and up 18.85% for the trailing year. Emerging markets, so think BRICS, think Brazil and Russia and India and China. China is still very much an emerging market. And then Pan Latin America and Pan Asia, up 7.93% for the quarter and up 10.27% for the trailing year. The TIPS index was up 4.7% for the quarter and up 3% for the trailing year. And oil closed the quarter at $71 a barrel, down about 10% from $79, nearly $80 a barrel at the end of 22. And I believe oil's running at about $75 a barrel at the moment. If there are no questions on the economic commentary, we'll go to the report. And Charles will be advancing slides as I speak, so this will be interesting. All right. So page 1 is your balance sheet as of December 31st. The total pension fund balance at the end of the year was $93,852,048.96. I believe Charles just handed out an updated balance sheet. It's just over $94 million at the moment. And that's taken into account flows, though we don't have that data just yet. The page 2 is a graphic representation of the prior page. Pie chart going from the large caps down to the mid caps and the small caps, your real estate, your internationals, emerging markets, Millennium Hedge Fund, around to the Breads and Bravos, up through the global bonds, high yield bonds, and the floating rate. Which again, I don't want to digress too much, but I think I say this every quarter, that the floating rate fund, at some point, if you'll back up one slide, Charles, that floating rate fund at the top left, at some point, we're going to have to figure out what to do with that, because as interest rates change, the utility of owning that floating rate will change as well. To give you an example of what it did for the fund, the bond index was up 5.5%, your total return managers were up 7%, and the floating rate bonds were up 12% last year. So it was a great insulation. It was great insulation for the bonds. Next slide is just simply an asset allocation by asset class. Domestic equity, 43%, 9% international, 5% real estate, 5% emerging markets, 32% fixed income, which is constituted by several managers, 4% alternatives, which again has several investments inside of it, and 2% cash. Also, before we go any further, what is the current cash level, Charles?
Current cash level, I believe we have around 886 in there now, and there are some outflows going. I believe Pam sent me the balances, and we're gonna have to raise a little bit of cash, I think, before the first. I think there was like a $200,000 cushion, but I think she likes a little bit more than that, so we're gonna raise some.
Okay. The next page is the unit value schedule, starting on page 4 of the report, starting back in 2011 at $43 million. Go ahead and just advance, if you would, Charles, to the next page. 2015, 2016, 2017. 2018. We'll stop on 2018 here. For the JR, John, just to recap this unit value schedule, we are on the right page. Okay. If we just look at 2018, that $40.2 million is the end of the year number for 2018. The $312,000 is the net, all the money that came into the fund minus all the money that came out of the fund. This negative 778 is what you think of when you think of return, nominal performance. It's net of fees. So any money going in or out of the pension fund does not affect that number, but any investment-related fees do affect that number. So it's a net of capital flows, net of fees. It's performance like you think of performance, net performance. Down 7.78%. That 124, we pegged $100 back in 2011, so you're up 24% from that period, net of those fees and net of those flows. The CPI is important because embedded in your target rate of return, you have a target rate of return of 7%. You have an embedded inflation assumption of 3%, so your real rate of return objective is 4%. Does that make...
7.5.
I'm sorry, 7.5 minus... I'm sorry. I miswrote it down. 7.5 minus 3 for a 4.5. That's what little typo. So you've got a 7.5% target rate of return, a 3% inflation assumption embedded in that rate of return, so a 4.5% real rate of return target, net of fees, net of flows, and net of inflation. Looking at this column of CPI, you see it's 73 basis points up top, 194, 2%, 2%, and you can see how the negative 3 at the end of 2018, exacerbated by the 2% inflation, became negative 5 as far as the actuary is concerned. So if you go to the next page, Charles, page 6, now we get to 2019. The pension fund's up 19%. You've got 2.2% inflation. 16.5 is what the actuary got. 11.5 for 2020. There's your COVID quarter, down 13.9%. Very low inflation due to very slow economic activity during COVID, the lockdowns. So the actuary got 10.14. And then 21 was 11%. Now inflation is really going to erode that nominal rate of return. So we go from 11.2 with a 6.9% inflation number, and now the actuary gets 4%. And then in 22, you see the real damage of negative 14.76, 6.5% inflation, which was persisting, so the actuary got a negative 20.54. Pretty clear why we include this CPI data. Next slide, please. So 2023, you're up 13.8% for 2023. That's net of all your flows. You'll also notice that these flows, since the $46 million was front-loaded by the city, the net outflows moving forward are going to be higher than they were historically because of that lack of, just on the cash flow basis. And you can see that pretty clearly. $1 million net out on the first quarter, another $1,900,000 and $830 or $840. So over that time period from 2011 to 2023, if you take all the money that's gone into the fund versus all the money that's gone out of the fund, you've had net inflows of $20.4 million. And that growth rate over that period has been 4.53%. Your inflation experience over that time period has been 2.58%. So your net number, 1.86%. At the end of 2021, see, our goal is to keep this 1.86 number as high as possible. Ideally, close to or hovering around 4 to 4.5%. At the end of 2021, we had taken the plan from 2017 to 21 from a 0 in that spot to nearly 4%. And 2022, with its inflation, that negative 20, just wiped out that good record for the period, for the meantime. Never want to run from the bad stuff. The next page is the executive summary. This is a page that Colby also printed out for you. The top is the 5-year, 3-year, and 1-year return of the portfolio in a balanced peer group. 7.42% is the net performance over the last 5 years. That's an annualized average, outperforming 60% of your peers. 2.55% doesn't sound like much over a trailing 3-year period, but it is outperforming 56% of your peers. And then on the 1 year, that 13.8 is in the top third of the database for the trailing 1 year. So 2023, in a nutshell, was a very good year for the pension plan. Looking at the individual managers, Loomis Sales, what we're looking for John and JR, these peer group rankings, you'll see that it's an alpha in rank, so these have been adjusted for the risk they take. And you'd like this number to be closer to 1 than 100. 100 would be bad, and 1 would be fantastic. So to take an example, Loomis Sales Growth Fund on the 3-year, it's got 636 peers, or competitors, if you will. And that 93 basis points of alpha, again, doesn't sound like much, but compared to their peers, they're outperforming 91% of 636 of their competitors. Or, put another way, 91% of your options, your alternative managers in that space. Vanguard Equity Income, 42nd. ClearBridge, 54th. Fidelity Low Price Stock Fund, 38th. Hood River, 12th. MFS New Discovery, 54th. Vanguard International Growth and Value are both up for a recommendation to be replaced, and we have a replacement that we brought with us. You can see that 96th percentile ranking in the 89th, and what that's telling me is that out of 199 managers and 219 for the value fund, that 96% of those managers are beating this manager on a trailing 3-year basis. Now, we didn't wait 3 years to come to this conclusion, but that 3-year number gives you a great sense of the magnitude of their recent underperformance. And once it's gotten into that 3-year time cut, the damage that they've done is not too bad, but it's getting worse. The opportunity cost of holding on to them is growing. And in a tax-exempt account, when you've got 96% of 200 managers outperforming yours, it's just easier to make a change than allow a manager to continue to do damage. Fidelity Emerging Markets, top decile. BlackRock High Yield, 17th. MetWest Floating Rate Fund, 38th. And so we'll get into the internationals in just a sec. Now, on the next page, you'll see that it goes from alpha to return in rank. So these are the investments that either don't lend themselves to a risk adjustment because their R squared is too small, meaning that the manager is so unlike their benchmark, to use the benchmark as a risk proxy doesn't make any sense. So they find themselves in the return rank category. Also, your index funds find themselves here because they're not designed to create alpha to begin with. We also have a mid-cap growth index fund in the Vanguard ETF that obviously is not designed to create alpha either. So the large cap core, 47th, 28th for mid-cap growth. The mid-cap core and the small cap have finally normalized. I know I kept saying this for a few quarters, but historically those are great places to index. And when 22 hit, it hit index funds harder than it hit anybody else because they're taking full market risk. And so when index funds are the greatest place in the world to have money when it's going up and a rough place to be when it's going down, because there's nobody at the helm managing any of that risk. You own what you own, and you're going to take it on the chin. And so historically, those have been places for index funds, but in 22, they got just hammered like everybody else. And we've been sort of looking for them to normalize, and it appears as though they have. Real estate, top decile. Guggenheim total return, 41st. PGIM, 38th. JP Morgan Global Opportunity, 2nd. Millennium, 1st, and 6th. And then you see just the return for, say, Breads. Breads was down 13.45% for the year. Charles, if you'd like to comment, you're welcome to.
Well, I just want to say that most of these values for the alts are stale. As Pam well knows, it's hard to get information out of these guys, so this is just the latest and greatest that we have. I would say they're average about 6 months stale. So we're looking at about 6 months ago. Thank you.
And one other thing I'd point out is that the exposure to these investments has drastically shrunk over the years. You're down to 230,000 with Breads, 623 with Cohesive Capital, 80 grand with PIMCO, and 584 with student housing. The next page, page 10, is simply your custom benchmark versus the return of the fund. Going back 10 years, of course, we were hired in the end
18.
of 17.
It's the beginning of 18, I believe.
The beginning of 18, so that gives us about 6 years on this chart. So if you go back to, and of course, the portfolio changed quite a bit when we were hired. We did do some surgery. But 4.34 on a 10-year basis versus a 5.19, 5 years, 7.42 versus a 6.94 on the benchmark. And I would remind the new trustees, the benchmark has no fees being taken out of it. So those are gross numbers for the benchmark because it's a hypothetical portfolio against which we're comparing this portfolio, which has all sorts of fees being taken out of it between the custodian and the consultant and the managers, which we'll also get to the fee analysis as well. 4.72 versus 4.92, 2.55 versus 2.56, negative 1.51, negative 1.41. And then 13.8 versus 13.66. So for at least the last 5 years, you've either been right on top of or ahead of your custom benchmark, which is a good place, nice place to be. This will be the final page of this report, the return rank for the total fund. And going back 10 years, y'all were in the 72nd percentile, 5 years 40th, 45th, 43rd, 40th, and 31st. So we're very, very pleased with the way the portfolio has matured and evolved, getting rid of so much of what was keeping y'all sort of behind the eight ball or lagging a bit. Any questions on the report before I move on to the asset allocation study?
Ready?
Yeah. All righty, on to the asset liability study. So let me blow mine up. So what we've done here, and we do this every year, we take the current target weights of the current managers, and we simply take them back as far as we can, as far as they all have common data. So what we've done is we look back, I believe this one is over, and y'all, you don't need to bounce around, Charles, but we'll get to this. But I just wanted to point out all but one of these investments started in January of 14. So we've got an entire about 11-year period that we're testing this portfolio over. So it's been through quite a bit over the last 11 years. But taking that portfolio, knowing y'all got a 7.5% target, this hypothetical has investment management fees taken out of it, but there's no consulting fees taken out of it. There's no custodial fees taken out of it. The administrator hasn't been paid. So if you test this portfolio over an entire economic cycle, we come up with about an 8.1, let's just call it an 8% rate of return with a standard deviation of, let's call it 11. And what that means really is that between, let's say, 19% on the upside to about negative 3 or 4% on the downside. Any annual return between those 2 points would be statistically considered normal. You'd be one standard deviation from the average. So in order to get the 8, we have to accept the fact that some years we're going to be negative 3 and some years we're going to be 19 to the top side. Now, some years, like last year, or rather 22, the portfolio reached two standard deviations. So it got all the way out to the tails, which I'll cover in just a sec. This next page is simply the mix. That's just the target mix for that's the mix that we use. And if you care to dig into this a little bit, you'll notice that Campus Clarion and Bravo and all those have become minuscule in this mix. The next page is the analysis inputs, which gives us the January of 2014 through December of 2023. And it also points out the marginal, meaning individual, return and risk for each asset you own, including Campus Clarion. And you can see where a lot of the risk is in the portfolio. Look at cohesive capital, 15%, but at a standard deviation of 31%. That's a swing. But we're looking out all the way about 11 years and testing the portfolio. The next page, I think, is got a little more meat on it. It's the portfolio statistics page. So 8.1 is that expected annualized return over an 11-year period. The expected risk is 11, as we just discussed. Now, when I mentioned 2 standard deviations from the average, this is what I was talking about. The best case scenario, there's a possibility the portfolio could go up 30% in a year. Is it likely? No. Could it happen? Yes. Same thing on the other side. Could the portfolio go down 12 or 13%? Well, it just did in 2022. It rebounded in 2023, 13.8, but it did take it on the chin. Actually, let me grab that number right quick. Don't move, Charles. 14.76 was what you were down in. So that negative 12, negative 13, that's a real possibility. Is it likely to happen? No. It's probably going to happen about every 25 years, statistically speaking. But you just can't get the 8 unless we're willing to accept these types of risks on either side of your average. And then so the best case scenario, 31, worst case, negative 12. The probability over that 11-year period of hitting your target rate of return is 51%. And then the probability of a negative, I think this is one of the most important numbers in the entire presentation. The probability of a negative 1-year return. What's the likelihood of just having a negative year? 0 or below. It's 25%. I can guarantee you that every 4 or 5 years, we're going to have a negative return. That's the nature of the beast. And it's right there in front of us. The next page, if you're really into this, it's a correlation matrix. So this is how correlated different assets are to each other. And when I made it into a PowerPoint for the presentation, it got a little funky with the fonts. But next page is the Monte Carlo simulation, or rather the inputs for it. 30 years to simulate, 10,000 trials, an inflation rate of 3%, and then the net outflows. We were pretty aggressive with this. We wanted to really, 3% inflation rate's going to ding the growth of the portfolio, but we also added a $4 million annual withdrawal, which is about that net cash flow that you're beginning to run after the city front-loaded those contributions. And then looking at the final page, you can see on the 50th percent, I've also busted this out on year 1, year 2, year 3, year 4. So it doesn't just jump to year 5, 10, 15, but you can get a better idea. So the 10th percentile would be the greatest thing that could happen, and the 90th would be a not so fantastic year. So is it possible that we'd go from 94 million to 104 in 1 year? It's possible, but not likely. The 50th percentile is by far and away the most likely. And an average flow of $4 million out per year. So I guess the takeaway to this, and I'll move on to the fee analysis because I know I'm running long, but the real takeaway from this is that in spite of the 3% inflation assumption and in spite of the $4 million outflow, as long as the portfolio is maintained with a good mix, good managers, and rebalanced diligently, there's no reason in the world why you shouldn't be able to pay all your bills, pay all your beneficiaries, and grow the fund despite those outflows and impact from assumed inflation. Any questions on the asset liability study before I move on to the fee analysis?
Why does outflow stay stable at 4?
I'm sorry?
Why does the outflow stay stable at 4?
It doesn't stay necessarily stable at 4, but that is our projected outflow.
But wouldn't you project it with the CPI at 3%? Or
No, that's our.
No, so that's the-
paying out compared to what we're coming in, but wouldn't we pay out more though over
Plus,
time?
we might have
It's an estimate.
drops,
Right, so
So-
4,
It's an estimate.
It's an estimate. Yeah.
and you might quit, and then you get your refund back. Those vary. It's not him, it's what we pay out.
okay.
And so every year, what we do is we analyze the net cash flows for the trailing year. And really, when they front-loaded that $46 million, that kind of threw that assumption set into a kilter because it became difficult to know exactly what that was going to look like moving forward. But at least now we've had that year. So the $4 million is really just predicated on the unit value schedule for 2023.
Okay, so you're just taking the 2023 and.
Exactly,
going through
and
it.
assuming that that's going to be the outflow. And I could make that grow, I could make it shrink, I could make it do all sorts of things. But for the purposes of the asset liability study, I don't want to try to assume too much. I'd like to keep it just as conservative as we can. Yes, sir. Any other questions on the asset liability study? All righty, on to the fee analysis. So this is the information that is used and submitted to the Pension Review Board on your behalf, which gives them an idea of what costs are associated with running the pension fund. You'll see your mutual fund and investment manager fees up top, $474,000. The custody charges, $23,536. And then the alternative funds, the Millennium, the Cohesive, PIMCO, Bravo, Student Housing, Blackstone, and Rastegar, $66,000. RHI consulting fees, $118,852. So total estimated annual investment management fees based on that asset value as of 12/31 is $683,525.89. And expressed as basis points, which is really what the PRB is most interested in, is what percentage of your fund you're spending on running your fund is 73 basis points, which compared to your peers in Telfra is a little lower than average. Any questions on the fee analysis? Mr. Chairman, are there any questions?
Any questions from the board?
Nope.
If not, I thank you,
All righty.
Mr.
Now, I
Harrell,
got-
for your presentation.
I got just a couple more items.
Okay.
I promise I'll get out of y'all's hair. So as I mentioned earlier on, and you've got that printout of the executive summary, both the Vanguard Growth and the Vanguard Value are both funds that we would like to replace. Charles and I have done quite a bit of studying on this and looking at the value and growth propositions of both of these investments. And what we'd like to do is consolidate them into one international developed manager. And that would be, if you'll pull up the MFS International, no, the other one, Charles.
The other one?
Yeah, it says MFS International, it's the fact sheet.
We have a copy up here, Will.
You know what though, Charles? I take that back. If you would go back to the Zephyr, please. Yeah, you had it right to begin with. So just as a general, there are a couple things about the Vanguard Value and the Vanguard Growth Fund that they've become funds that we're not as thrilled about as we were when we first hired them. And there are a couple of reasons for that. If you go to you can see here, you can see the style drift that you often hear about, quite a bit when the green and quite a bit in the purple. So there's been quite a bit of style drift with these two managers. Also, the Vanguard Value is now 21% emerging markets, and we already have an emerging market manager. And the Vanguard Growth has become 15% emerging markets. And the Vanguard Value is 5.3% U.S. companies that make their money overseas, and the Vanguard Growth has become 17.6% companies in the U.S. that make their money overseas. And so what Charles and I were looking for is a fund that is more conservative, has fewer holdings, and had almost zero U.S. holdings with their money made overseas. We wanted as little emerging markets exposure as we could possibly find, but we also wanted it obviously to be high in its peer group. And we've settled on the MFS fund. Let me now go back to that fact sheet. It's the MFS International Equity Fund. It's very old, it's been around forever. The managers have been there a good long time. It's very straightforward. It's a well-diversified portfolio, high conviction ideas. It's got about 80 holdings, so it doesn't have hundreds of holdings, but it doesn't have 25 either. Stock selection is their primary source of alpha generation. High quality, attractively valued companies. It's kind of like a GARP, growth at a reasonable price for internationals. And so when you look at the top 10 holdings, Air Liquid, Nestle, SAP, Roche Holdings, Pharmaceuticals, Hennessy, Louis Vuitton, Hitachi, Compass Group, Novo Nordisk, another pharmaceutical company, a giant pharmaceutical company in Europe. It's just, it's really exactly what we were looking for. It only has 6% emerging markets, which is right where we wanted it, and it's only got 1.5% exposure to the U.S. So it's really an international fund. It's not trying to blur the lines between the two, or rather invest in American companies that the vast majority of their earnings are coming from outside the United States. Because we already own those companies in your large cap funds. In your domestic equity large cap funds, those companies are already represented. We don't need them in the international side. So we were trying to get rid of that overlap and also get a really pure developed markets manager. Because it's not, and also Vanguard had really, they've always had a sub, and I don't want to go too into the weeds, but they've always taken a sub-advisory approach to their international funds. So it's not Vanguard per se that's running those funds, that's making the decisions. They'll have 2 or 3 sub-advisors, and we've seen those sub-advisors turn over in the last couple of years, and when that happened, we saw the performance go down. So there are a variety of reasons to make the change. Because it's not a Vanguard fund, obviously the fees are going to be a bit higher. The Vanguard value and growth were 38 basis points and 31 respectively, and MFS is 76 basis points. Page 2 of the, thank you, Charles, that's exactly what I was looking for. Page 2 has the annual returns versus its benchmark going back to 2014. And across the board, you can just see handy outperformance. Go all the way back to 2017, 28-25, -10, -13, 28-22. There's plenty of outperformance there to make up for the 30 basis points of additional fees embedded in the fund. There are the expense ratios. Y'all would clearly be in the institutional share class. It's been around since 1996, $17 billion in assets, 80 holdings. And this is another thing we liked about it, only 8% turnover. So it's a high conviction, steady as she goes international fund that we think will be a great replacement for the Vanguard growth and value. Would you please pull up the Zephyr and then just move on to the risk return scatter plot, next page. So this would be the risk return scatter plot for MFS versus its entire peer group. This is trailing from 2019 to 2024. You can see that 9.4% is an annualized average versus its benchmark of 692. Standard deviation is just under the benchmark, so better than average, quite better than average returns, 50% better returns, and less risk. Downside risk is under the benchmark. There, you can see that, what I mentioned earlier about having index funds, you see that 0.96. It means that someone is actually controlling that risk. 2.6% alpha versus the market, which is a great number. You can see the benchmark does not create alpha. The R squared is how well we understand what's happening with the manager. And if you would just hit the next, the return page. No, sir, the next one. Yes, sir. The return page. So this would be the return again, and we've just looked at this, but this goes back 5 years versus its benchmark, and then the median manager is the top row. The next page is the return rank, which you know we live and die by. So it's top decile all the way through the 1 year, top quartile, and dipped a little on the year to date. And then the alpha on the next page, 2.53 on the trailing 5-year, a little negative on the short term. That doesn't really give us too much indigestion. Look at the median manager, -3, -2.83 over these last 2 years. And then the alpha rank, which of course you know is our favorite metric. Top decile all the way across the board. The 1 year's in the 25th, but again, very consistent, very reliable, very understandable, very little EM exposure, very little US exposure. It sort of checks all the boxes of what we were looking for, and so the final piece of my presentation would be to ask approval to make the change from Vanguard Value and Vanguard International Growth to the MFS International Equity Fund. And would you like me to go ahead and go through the IPS before y'all make, okay. And now, and so that would, are there any questions on the manager stuff whatsoever? All righty. So the investment policy statement would be the final exhibit. February 20th of 2024. Our chairman corrected something that I had misspoken very early on in my presentation, which was embarrassing, but that's okay. And I'm going to have to make a tiny typo correction in the investment policy statement and resend it to you, which is something I can do before I leave today. But this investment policy statement has been updated through 2024. The first page is where I find my typo, rate of return objective. Nominal rate of return, that should be 7.5 on page 2. Inflation adjusted real rate of return will be 4.5. And then there's your 3% inflation assumption, and that's as of the last actuarial valuation as of December 31st of 2022. And it's expected that the portfolio's return will meet or exceed the actuarial assumption rate of return over an average 10-year period. And that's how we measure public pension funds. You just can't look at them for 5 years or 3 years or 6 years. It needs to be closer to an entire economic cycle. Page 2 has not changed. Page 3 of the document has not changed. Page 4 of the document has not changed. Page 5 of the document has changed. The new trustees have been added to this last page, and it needs to be signed to be ratified by the new trustees. And I will fix this. I will fix the typo and send it to you before you get out of your chair, Mr. Chairman. And that would conclude my longer than normal report. I appreciate your patience. John and JR, they're usually not that long. We usually just do the report, maybe a manager change. But this first quarter of every year, we do the fee analysis, the asset liability study, and a little extra. Sir?
Page 3 of the investment policy statement under diversification.
Yes, sir.
Second line, the maximum exposure to any economic sector shall be 30% of the total portfolio market, and the maximum exposure to an individual security shall be 5% of the portfolio market value.
Not your portfolio, their portfolio. The investment manager's portfolio.
Do we have rails on portfolio in an individual, like if we were to move everything into MFS, which I have no problem with the explanation and where they're at, we're going to be pretty close to 10% of the fund in one manager.
It would be right at 9. Yes, sir. We would keep that target at 9, which I believe is the aggregate of the two, of the value and the growth. Hold on. Let me look here right quick.
It's a little bit.
4248. It would be, I believe it is 9, the target. The target is 9.
The target, okay.
Yes, sir. So what the target weight for those two would be 9. They'd be under the threshold.
Would it be, I guess, in the interest of diversification, better to keep those separate than have all the eggs in that one basket, or you feel like that basket is just designed well to fit both those roles?
We do. For that asset class and internationals these days, we do.
I believe it's the way we did it before as well.
Originally, that's how it was. Originally, it was one fund, and we busted it out between two.
Any other questions? Good.
All righty. Well,
Thank you,
thank
sir.
you very much.
If you'll hang out just a second, we'll move forward with those votes to get you those answers. All right, so we have action item A, review and motion regarding the recommended trades for the fourth quarter pension performance presentation.
Motion to approve.
Second.
Recommended trades.
A second.
All right, motion and second to approve the recommended trades and rebalance, or
Move Vanguard International and
yeah.
value to the NFS.
yes, all right, to MFS. All right. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. All right. Motion to approve I'm sorry, one more. A motion to approve the updated investment policy statement with the corrections stated by Will, that'll be made on page one.
Page 2.
Page 2.
Can we vote on that if that's not on the agenda?
Well, I think it would actually fall under the recommendations. Well,
Okay.
it says trades.
I'm just documenting for Pam. I move to approve the investment policy.
Second.
Who said that?
With the changes
Yeah, yeah.
from
With the
the,
changes that-
with the changes of total nominal target rate of 7.5%.
I just emailed those corrections to Scott and you. Colby, I'll put you the correct one here, so y'all can sign it for you.
All right. All right, motion and second to approve the investment policy statement with the corrections made by Mr. Harrell. Any discussion? If not, all in favor say aye.
Aye.
Aye. Anyone opposed? Motion carries. All right. Review and motion regarding the reconciliation for the month of January 2024 for Moody checking account, Moody disbursement, and Morgan Stanley Smith Barney Omnibus.
Who is Nick Killian? I don't see him in the orange.
I believe we voted last meeting on refunded contribution. He had a
Then I'm good with it.
off-duty injury that made him unable to
I
return.
move to approve the reconciliation.
All right. Got a motion and second to approve the reconciliation for January 2024. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Item C, review and motion regarding the internal financial statements for January 2024.
How is this different from our asset allocation schedule at December 31st? Usually you can go to the second page on total assets, and we're at 92.7, and our schedule's at 93.8.
Now, this is January 31st.
Yeah.
Oh, I'm sorry, that would be the problem. Never mind. Then I move to approve the financials.
Second.
Motion and second to approve internal financial statements for January 2024. Any discussion? If not, all in favor say aye. Aye. Anyone opposed? Motion carries. Item D, review and motion regarding the minutes from the January 2024 meeting. Yeah, E was Mr. Killian.
Yeah, I see that now. I've forgotten this up since then.
Motion to approve the minutes. Second.
A motion and a second to approve the minutes, January 2024 meeting. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Action item E and F are an update signature for the travel and ethics policy for the pension fund There has been no changes to either of the policies. It's just updating the signature page due to, it's been, I think, 2015 and 2008 the last time the board signed it. So there is no changes to the actual policies, though.
Who's got the one that we're signing?
I have some right here. And then we'll get, well, I'll tell you what, I have a signature page for the investment policy statement that we can use. And I will attach it to the corrected one there too.
We'll pass the pages down.
I'll approve them.
Oh. A motion to approve the travel policy?
And I think policy.
Yes.
All right. Second. Motion and second to approve the updated signature page for the travel and ethics policy. Is there any discussion? If not, all in favor say aye.
Aye.
Aye. Anyone opposed? Motion carries. Item G, review and motion regarding the refund of contributions to Joshua Pettigrew due to separation. I actually checked this and verified, so if you'll make the motion, I'll gladly make the second, because I did do the verification on this.
Motion to approve.
All right, and I'll second. Mr. Pettigrew has moved to Alaska to move forward in his career. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Discussion of upcoming retirements. I am currently not aware of any. You are the vice chairman on that page, I believe. Adopted February 20th, 2024. All right. Discussion of status of cyberware ransomware insurance proposals.
Yeah, so I'm currently in the process. I've gotten, getting a couple quotes on that, and so they've got the information for that, and just waiting on the proposals for that. So we should have it by next month on the next meeting, and we'll have 3 different proposals, and we can discuss it further at that
Which
point.
one we got for the city?
That's through HR, I don't know the name of it. But we do have it,
You do have it.
we're well covered.
So it's in.
So anyway, we can slide in under that coverage?
Chair.
Oh, sorry. Yes, ma'am. Thank you for looking at that.
All right, next discussion item is the draft potential TELFRA governance issues. It should be located in the back of your book. There was, it's about
On
a,
this one?
11 pages.
that would be, yes, sir.
On that one.
What is that?
Governance issues.
Oh, I saw it.
So there, yeah, there was a committee formed by the Pension Review Board to address governance issues and make recommendations. From there, they contracted with some students at the LBJ University. Yeah, thank you, sir. School of Public Affairs, and charged them or contracted with them to do some interviews and make some recommendations. That report was actually received, I think, 18 months ago by the Pension Review Board, but they had kind of kept it close to hand, because I think some of the recommendations were coming from people that, other than going to school, that didn't have any real public pension knowledge, and I think some of the recommendations might have not been feasible. I've seen some of the recommendations. I've never actually seen the full report on that yet. But from that, they were directed to do some interviews of what governance issues might be out there and what recommendations. could be made. There's been 3 meetings that have had representatives from large funds and smaller funds. Myself and actually former Councilwoman Kristen Ishihara served on this board, her as the city representative when we went through the pension obligation bond, and then myself as a member of this board. And from that, they have produced the document in front of you and was presented to the Pension Review Board Committee. This is a draft version. These are some ideas that have been hashed out and identified, some of which I can honestly say I never remember discussing at all in any of our 3 meetings. But in short, one of the things, system funding and decision-making practices, and of course, there's a lot of reading there. They were addressing the decision-making process, and their recommendation on page 4, well, hold on. Identified issue, tougher statutory decision-making process may hinder progress towards resolving funding issues faced by many Telfer systems and their sponsors. And one of the reoccurring issues that we saw in our meetings was the fact that Telfra as a whole is a very diverse animal. We have funds that have $2 and $3 million in the valley that face different challenges than Lubbock does with $300 million in West Texas, and where the City of Longview pension fund has a good working relationship with their cities, there's other funds that don't have good working relationship with their cities and can't move forward. So there was a real broad spectrum of examples, and I can't particularly say any one group was the majority. I think we just had examples all across the board, and really I think the basis of this is stemmed off the September 30th, 2025 deadline to get under 30 years, which is why we passed the pension obligation bond and moved to where we were. In fact, I think we're listed in some of the examples here. So no legislative change was made in that. The next one had to do with preliminary recommendations, statutory, regulatory, legislative on page 5. The discussion was requiring the sponsoring entity to first approve any ballot options concerning benefits or contribution changes prior to a member vote. This recommendation would ensure sponsor and systems work collaboratively on potential changes before going to a member vote, and could change the incentive structure to make it more likely sponsors would be less hesitant to provide necessary employer contributions. And then some other PRB guidance listed before there. The main ones that were hit are going to be in topic area 2, board structure and membership. And they were using examples of Galveston Police, Austin Police, San Antonio Police, Austin Police, Houston Police, if you hear something that sounds like it's repeating there. And that was 2 ideas were brought forth of either adding a city board representation to bring the board to 8, or to remove one of the citizen board member positions and keep the board at 7 and have a 3 and 3. These are all just ideas that are being passed out, and it's not our decision to make. They're open to, I think Pam might have sent it, if not, I'll forward the email. They're taking comments from members and board members about these different subjects, but these are the things being discussed, and I felt it was important that I at least bring it to the board, that they understand that these discussions are happening down at the CAP. Doesn't necessarily mean any of them will come to fruition, but at least you're aware of what it's going. And then the last one had to do with the citizen board members and compiling some recommended qualifications and what to look for in a citizen board member. I informed them we have historically always had an investment person and an accounting style person or 2 citizen board member spots. Some funds have none and have members that have no experience in there. Some only do investment people, and so on and so forth. So please take that document home and read it. I believe there's links to where to go to it. Otherwise, it will be on the Pension Review Board's website if you want to make any comments in regards to that right there.
Is there anything we need to do to focus on any of these identified issues now for us to start looking at or working on, or? I know it's preliminary, but if there's anything that we need to start considering outside of just reading the document, I didn't know what you needed to.
So I'll have some comments personally on there. I've been asking for a breakdown, and again, this varies city to city. A lot of times we've seen where a fund comes out of compliance for MET training, and it just says the fund has come out of compliance, but it doesn't really break down, is it a citizen board member that's brought them, is it a firefighter board member, or is it a citizen or a sponsoring entity person that has brought that non-compliance. I've verbally been told that a lot of times it is the sponsoring entity that doesn't have. We found ourselves almost in that situation before Mr. Newstead showed up, thankfully. And so that would be one of my concerns. If that's the highest category that brings funds out of compliance for training, adding another position, I think, would just increase your exposure to that bringing him out of compliance. And a lot of times it just has to do with the professional lives of people not having the time to attend training. But we'll have to do some more investigation into that. They brought up MOUs, which we already have one. Actually, ours was used as an example. Where a lot of fund has engaged with their sponsoring entity on quelling the concern that if they were to input more money into a fund, that it would just turn around and go into benefit increases, causing, future liabilities. All right, discussion of board position members. So this is actually where we nominate and elect the chairman, vice chairman, and secretary positions for the year.
I nominate Colby to be chairman.
You can go ahead and throw them all out there. It'll save us 3 votes.
Nominate Logan to be, JR to be vice chair and Logan to be secretary.
All right. Got a nomination. Do I have a second?
I'll second.
All right.
Logan should have been here.
Poor
He is
Logan.
stuck in a training he does not want to be at.
He would much rather be here, I promise you, yes. Do I hear any other nominations? If not, nominations will cease. We'll skip the vote due to there only being one and proclaim those positions filled as listed. It's also time for a re-election of a 2-year term of one of our citizen board members, beginning March 2024. Miss Vicky Boggio has been serving in the citizen board position second term? End of your second term? Partial term and then second term?
1.5. I
What,
believe.
1.5?
1.5.
All right. Would you be willing to continue in your role as a citizen board member?
I wish I'd had more time to think about it. No, yes, please. I would be honored.
Well, I will make the motion to re-elect Vicky Boggio for a 2-year term to the Firemen's Relief and Retirement Fund.
Second.
All right, I have a motion and a second. Is there any other nominations? Any other nominations? If not, nominations will close by proclamation. Welcome back to the board, Ms. Boggio. Thank you.
Thank you.
Upcoming conferences, Texpers 2024 Annual Conference, April 7th through 10th in Dallas. I believe everybody has signed up and is together. I believe everybody's received their invitation to dinner with Will and Charles. Did I not see your name, Maria?
It's tax season.
Oh, that is tax season. I forgot. Angela? Is your name?
Oh, be in Florida at Walt Disney World.
Not a terrible
I'm
Plan
going
B
to Disney
choice.
World, too.
During tax season.
All right, next regular scheduled board meeting is March 19th at 8:30 a.m. That'll be back at the pension office. Any other discussion before we close?
The only other discussion was back to John's question on the Monte Carlo simulation on page 7. We were talking about continuing with that $4 million every year. I mean, the estimation is that with inflation and increased retirements, that number's going to change. Is that something we should start looking at to adjust that? Over time.
I can adjust it any way y'all like. I can make it grow, you know what I mean?
I mean, the expectation is that that would grow
Absolutely.
every year. I just didn't know if that's something we need to start trying to plan for.
The drops in the retirements,
Yes, ma'am.
we don't know about.
I understand
That's
that.
a
I
flexible-
know that's a
I mean,
flexible. I
we
just didn't
know
know if
the-
it's something we should start.
We know the
Considering.
when I say the retirements, the ones that leave service, we don't know about, and the drops.
For
So
sure.
that
Yes,
number
ma'am.
varies, but we can be steady on the pension people
Right.
for the most part.
I just,
But those other two,
20
Can-
years
can-
from now,
But I
I
can
think
put
it's going to be more than 4 million.
inflation, like you're saying, I can put an inflation growth component to the $4 million.
Yes, sir.
he could-
So you could have the 4 million grow with the rate of inflation at 3%. You could have the 4 million grow it really anything you like. But you're right, Marie, it's tough to predict the lump sums, but bless you, but,
And there is going to be a little bit of a change of that. I think the inflation probably is a good,
I think that's the most reasonable.
yeah,
Yes.
non-biased
Yeah.
way of letting it grow there. With the big change coming in 22 years? When the bond pays off, the 7% will go back in. So
Back up to-
you'll see the
Yes.
I
The-
can
the
model
jump
all of
back.
that in. I can model every bit of that in if you like.
all right.
Sorry. Yeah.
No, that's what
So
we're.
what I'll do is what I'd like to do is rerun it and have the $4 million grow at the 3% inflation rate. Would that make sense? And then in 22 years, have the have that $4 million essentially drop off where it becomes a wash at 22 years, or closer to it.
I still wouldn't be a wash though.
Yeah, I don't think it'll be a wash.
It wouldn't be 4 million.
It would be less than 4
Probably
million.
half of it, actually, I think.
Yeah.
Okay. Well,
Yeah.
I'll work on it and I'll get it to you.
All right.
Yes, sir. Only one other thing I wanted to mention I neglected to is that since y'all put the $46 million into the pension fund, if you just look at it on a cumulative basis, thinking about what's happened to that money since it went into the pension fund, it's grown about 19%. And if you were to annualize that, Charles, what would you call it? It's only been a year and a half, so you
Well,
could
yeah,
ballpark
July, I
it.
think it was a year, right?
So maybe 12%
If
annualized.
you annualize it, anything over a year, yeah.
All right, I'm going to repeat that only because I'm on microphone and they probably didn't hear that, anybody watching this on YouTube. So what Will Harrell said, the $46 million bond influx money that was influxed into the fund, since its injection into the fund has earned right at 19% return, roughly 12% annualized.
It's a good time.
Absolutely.
Do I have a motion to adjourn?
Motion.
Do I have a second?
Second.
All in favor, say aye.
Aye.
Thank you.